First we have to value the stock. There are two types of stock, tins and packets. Out of 3000 tins sent, 100 tins lost and 2000 tins sold. Balance is 900 tins are in stock. And packets, 10,000 packets we sent. Out of this 6,000 packets are sold. Balance is 4,000 packets. We have to value the closing stock of 900 tins and 4,000 packets. Cost of goods sent, 900 tins into 20 rupees, 18,000. Packets, 4,000 packets into 10 rupees, 40,000. Consignors expense nil. Consignees non-recurring expense 5% of the cost. 18,000 into 5%, 900. 40,000 into 5%, 2,000. Tins total value 18,900. Packets total value 42,000. Therefore, the grand total 60,900. That is the value of the stock. That should be compared with the net realizable value. Whichever is less should be taken as the value of the inventory. In this question, net realizable value is not given. Therefore, we assume that the cost is less than the net realizable value. Therefore, the value of the stock is 60,900. Then abnormal loss, 100 tins. Cost of goods sent, 100 tins into rupees 20, 2,000 rupees. Courier charges 5%, 2,000 into 5%, 100 rupees. The gross abnormal loss is 2,100. An insurance company admitted a claim of rupees 1,500. Therefore, net abnormal loss is 600 rupees. Now we can prepare consignment account. Two goods sent on consignment. 3,000 tins into 20 rupees. 10,000 packets into 10 rupees. That is the cost of goods sent, 1,60,000. Consignors expenses 5% nil. Consignors expenses nil. Consignees expenses to be limited 5% of the cost, 1,60,000 into 5%, 8,000. Consignees other recurring expenses, go down rent 5,000. Sales, so by B Limited, 2,000 tins are sold at the rate of rupees 30. 6,000 packets are sold at the rate of rupees 20. So total 1,80,000. Then commission, 10% of sales to be limited, 18,000. Buy stock on consignment, we already valued the closing stock, 60,900. Abnormal loss total 2,100. We can present like this: by insurance company 1,500, by P&L 600, or we can just post like this: by abnormal loss 2,100. Then find out the profit. Credit side is more than the debit side, therefore to P&L 52,000. Consignee account, B Limited account. To consignment, the sale amount is 1,80,000. By consignment, his expenses, that is courier charges, 8,000. By consignment, the non-recurring expenses of 5,000. By consignment, his commission 18,000. By balance carried down, that is the amount due from B Limited. Next question. C Limited consigns 100 kilograms of food packet costing rupees 2,000 per kilograms to D Limited. Expenses incurred by C Limited: loading 1,000, carriage 1,000, freight 3,000. D Limited sold 45 kilograms at rupees 3,000 per kilogram. D Limited incurred the following expenses: port clearing charges 7,000, storage expenses 2,700, selling expenses 3,300. 20 kilograms lost in transit, 10 kilograms are still in transit. Commission to D Limited rupees 200 per kilogram sold. Show consignment account. Before preparing the consignment account, we have to find out the stock value, value of goods lost in transit, value of goods in transit. 100 kilograms of foods are sent on consignment, out of which 20 kilograms are lost in transit, 10 kilograms are in transit, 45 kilograms are sold. Therefore, balance stock with consignee is 25 kilograms. First we value abnormal loss, that is the goods lost in transit, 20 kilograms. The cost of goods sent is 20 kilograms into rupees 2000. Consignors expenses incurred total 5000 on 100 kilograms. Therefore, for 20 kilograms, 5000 divided by 100 into 20, rupees 1000. Consignees non-recurring expenses, port clearing charges, that is not applicable for goods lost in transit because the goods already lost. Therefore, total cost of goods lost in transit is 41,000. There was no insurance, therefore the net abnormal loss is 41,000. Therefore, credit in consignment account by abnormal loss 41,000. Next, value of goods in transit, cost of goods sent 10 kilograms into rupees 2000, 20,000. Consignor expenses total is 5,000 for 100 kilogram. Therefore, for 10 kilograms, 5,000 divided by 100 into 10, rupees 500. Consignees non-recurring expenses not applicable. Therefore, total 20,500. Next, value of stock with consignee 25 kilograms, cost of goods sent 25 kilograms into rupees 2,000, 50,000 rupees. Consignors expenses total 5,000. Therefore, for 25 kilograms, 5,000 divided by 100 into 25. Consignees non-recurring charges, that is the port clearing charges, total he incurred 7,000 for 70 kilograms. He received only 70 kilograms. Therefore, for 25 kilograms, the port clearing charges is 7,000 divided by 70 into 25. That is 2,500. Therefore, total value of the inventory 53,750. That should be credited to consignment account. The consignment account will appear like this. To goods sent on consignment, 1,000 kilograms into 100 kilograms into 2,000, that is 2 lakh. To bank, his expenses 5,000. To be limited, consignees expenses total 13,000. By B Limited, the sale amount is 45 kilograms into 3,000, that is 1,35,000. To B Limited is commission 200 rupees per kilogram, 200 into 45, 9,000. By stock on consignment 53,750 with consignee and 20,500 in transit, total 74,250. By abnormal loss 41,000 to P&L 23,250. Next question. X Limited consigned to Y Limited goods to be sold at invoice price, which represents 125% of cost. Y Limited is entitled to 10% commission on sales at invoice price and 20% of any excess realized over invoice price. In addition, 10% on sales will be paid as del creditor commission. X Limited incurred freight rupees 8,000 and insurance rupees 2,000. 85% of the goods sent are sold for rupees 2 lakh. Y Limited incurred rupees 10,000 as selling expenses. That is the consignees expenses. 10% of the consigned goods to the value of rupees 15,000 were destroyed in fire at the godown of Y Limited. The insurance company paid rupees 12,000 as compensation. A customer turned insolvent, could not pay rupees 6,000. Prepare consignment account in the books of X Limited. In this question, dull creditor commission is paid. Therefore, the bad debt is the headache of consignee, and consignor will not take the risk of bad debt. In this question, the value of goods sent is not given, but the value of goods lost, that is given, 15,000. 10% of the consigned goods to the value of rupees 15,000 were destroyed in fire at the godown of Y Limited. From that we can find out the value of goods sent. Friends, goods sent are invoiced at 125% of cost. That means the pro forma invoice is prepared by adding a profit loading of 25% on cost. Therefore, we have to remove the value of profit loading from the cost of goods sent and also from the closing stock. First, we will find out the invoice value of goods sent. Invoice value of goods lost is 15,000. That is the 10% of the consigned goods. Therefore, invoice value of goods sent is equal to 15,000 divided by 10%, that is 1,50,000. So, in consignment account, we debit to goods sent on consignment 1,50,000. In that 1,50,000, there is a profit loading, that is loaded 25% on cost. Therefore, the profit loaded is 1,50,000 divided by 125 into 25, that is 30,000. Therefore, the cost of goods sent is 1,50,000 divided by 125 into 100, 1,20,000. The cost of the goods sent is only 1,20,000. On that 30,000, that is 25% of cost, 1,20,000 into 25%, that is 30,000, profit is added and invoice is prepared for 1,50,000. Therefore, this 30,000 should be removed from the consignment account later by goods sent on consignment 30,000. Next, we will calculate abnormal loss. The cost of goods sent is 1,20,000, 100%. On that, consignor expense is 10,000 is incurred, total 1,30,000, of which 10% is lost in consignees godown, that is 1,30,000 into 10%, 13,000. Insurance company admitted a claim of rupees 12,000, therefore net abnormal loss is 1,000. So, in consignment account, by insurance company 12,000, by P&L 1,000, total 13,000. Next, stock valuation. 85% of the goods are sold, 10% of the goods are lost in consignees godown. Therefore, 100 minus 85 minus 10 is 5. 5% stock with the consignee. Invoice value of the total goods sent 1,50,000, total consignors expenses 10,000, total 1,60,000. 5%, 1,60,000 into 5%, rupees 8,000. By consignment stock 8,000. Remove the profit loading. Total profit loading is 30,000. 5% is 1,500. So, debit in consignment account to stock reserve 1,500. Next, calculation of commission. There are 3 commission. 1, 10% commission on sales and 20% of any excess realized over invoice price, and in addition 10% on sales will be paid as dull creditor commission. The invoice price of the goods sold is 1,50,000 into 85%. Total invoice price of the goods and 1,50,000, of which 85% is sold. Therefore, invoice value of the goods sold is 1,27,500. The sale amount is 2 lakh. Therefore, the excess of sale price over invoice price is 2 lakh minus 1,27,500, that is 72,500. Therefore, the commission is first commission invoice price into 10%, that is 1,27,500 into 10%, 12,750, and for any excess, that is 20%, that is 72,500 into 20%, 14,500. In addition, a calculated commission of 10% will be paid on sales. 2 lakh into 10%, 20,000. Total commission is 47,250. That should be debited to consignment account. The consignment account will appear like this: to goods sent on consignment 1,50,000, to bank consignor expenses 10,000, to Y Limited consignees expenses 10,000. To commission, we already calculated 47,250. To stock reserve, that is the removal of profit loading on stock, 1,500. We already calculated that. By Y Limited, the sale amount 2 lakh. By goods sent on consignment, removal of profit loading on goods sent, that is 30,000. We already calculated that. By insurance company 12,000. By P&L 1,000. By stock on consignment 8,000. To P&L the profit. Consignees account will appear like this: to consignment, the sales amount 2 lakh. By consignment, his expenses 10,000. By consignment, the commission 47,250. By balance carried out. The balance is 1,42,750. In consignees book, the journal entry will be like this: expenses incurred by the consignee, X Limited account debtor, to cash or bank, he incurred 10,000 rupees as expenses. The sale amount is trade receivable account debtor 2 lakh, to X Limited 2 lakh. Commission receivable X Limited account debtor to commission earned 47,250. Since the calculated commission is received, therefore the bad debt is the risk of consignee. He should bear the risk of bad debt. That should be adjusted with the commission earned account debtor to trade receivable. Friends, hope you benefited from this video. Please share the video with your friends. Please subscribe our channel. Press the like button and notification button. Keep watching videos. Thank you so much for watching.